You know, for decades, there was this unwritten script for the founder-VC relationship. Founders would go hat in hand, VCs would sit on their throne, and capital was king. But what if that whole script has been torn up and thrown out? Today, we're diving deep into a huge idea, the great inversion. We're going to explore how AI hasn't just changed tech, it's completely flipped the power dynamic in the startup world. Let's get into it.
And boom, that sentence right there, it just nails it. It basically says that all the rules, all the metrics, the entire mindset that built Silicon Valley, well, it might be the very thing holding it back now. We're not just talking about a software update here. We're talking about a complete system overhaul. So what did that old playbook even look like?
So this old playbook, it was all about one thing, playing it safe. It was about mitigating risk in a world where just building a company was crazy expensive and getting information was tough. I mean, this was a framework for a world before AI, before you could reach millions of people from your laptop, and way before a founder could build a working prototype for less than the cost of a plane ticket to Sand Hill Road.
Okay, to really get this, you gotta understand what a VC's job actually is. At their core, they aren't some visionary builder. Their title, their primary function, is fund manager. Their number one job is to take capital from their investors, the LPs, and above all else, manage the risk of losing that money. And this context is absolutely critical because it explains why so many of them are wired to play defense.
Think about it. If your main goal is to not look stupid in front of your own investors, you're not incentivized to make the crazy, world-changing bet. You're incentivized to not lose. And that defensive posture is why they cling so tightly to these familiar, safe, backward-looking metrics.
Ah, yes, the classic, show me traction. I bet every founder listening has heard this one a million times. And on the surface, it sounds totally reasonable, right? Just show me that people are using your thing. But it's a demand that completely misses where the real, game-changing value comes from.
And here is the perfect example of why that's broken. If the Instagram founders had been judged only on traction in the traditional sense, revenue, the company would have been dead in the water. That billion-dollar price tag was for its potential, its community, its insane growth, not its profit and loss statement.
Here's another golden oldie. Prove your customer acquisition cost versus your lifetime value. Basically, show me on a spreadsheet that you make more money from a customer than it costs you to get them. Again, super logical, but if you try to force a brand new, world-changing idea into that box too early, you'll kill it before it even has a chance to breathe.
The reality, it's just nuts. WhatsApp sold for $19 billion, and they didn't have a clue how they were going to make money. They had 1 billion users who loved the product and a direct line to a huge chunk of the planet. The value is in the network, not a spreadsheet. So yeah, these old rules, they're not laws of physics. They're just suggestions, and often pretty bad ones.
So what changed? What was the big earthquake that just shattered this old model? Well, it was AI. Plain and simple. Artificial intelligence has basically collapsed the cost of everything. Of creating, of experimenting, of distributing. Something that would have taken a team of 10 people and $1 million in seed money a few years ago, a single founder can now build it on a weekend.
And look, when the fundamental physics of building a company get turned upside down like this, everything else has to change too. The old playbook, the old metrics, the old power structures, they're all on life support. The rules have officially changed.
So let's break this down, then versus now. Back in the day, a VC would ask for backward-looking stuff, like revenue. But now, what really matters is your speed of iteration. How fast can you learn and improve? They wanted to see a clear product-market fit. Now, the exciting thing is what new capabilities your tech unlocks for people. They looked for moats built on scale. Today, your moat is built on unique data, your taste, and finding clever ways to reach people.
Okay, so this all leads to the big question, right? If the metrics are different and the costs have just plummeted, what does that actually do to that old-school founder-VC relationship? How exactly did AI flip the entire model on its head? And the answer is simple, but it is huge. The power has shifted. We have gone from a world where capital, the money, was the rare, precious thing, to one where visionary creators and builders are. The power isn't with the person writing the check anymore. It's with the person building the future.
This chart really says it all. In the old world, you were totally dependent on VC money just to get started. Now, you can build and prove your idea for less than 10 grand. You needed their Rolodex for distribution. Now you can go viral on TikTok. You relied on their gut feel pattern recognition. Now, honestly, you can probably model potential outcomes with AI more accurately than they can. The bottom line here, every single pillar that held up the VC castle has been weakened or knocked down by technology.
And this is probably the most important thing to get. Money is cheap. It's a commodity. There are a million places to get it. But a true partner, someone who gets the new world, who moves as fast as you do, and who brings more to the table than just cash, that is incredibly rare.
Okay, so you're a founder. You got the power now. What do you do with it? It means you're not just showing up to be judged anymore. You are conducting the interview. You need a completely new playbook for how you evaluate investors.
All right, let's talk red flags. What are the warning signs? First, if a VC wants traction but gets all vague when you ask how much is enough, they're probably just wasting your time. That whole "we only take warm intros" thing, that's just code for a lazy, closed-off network. And be really wary of anyone who says they're passing based on pattern matching but can't actually tell you what the pattern is. It's often just an easy way to say no without thinking.
And it doesn't stop there. Vague promises about helping you after the investment usually mean zero help. A fund that needs every single partner to say yes is designed to kill bold ideas. And, of course, if they ghost you, drag their feet, or, the absolute worst, try to mansplain your own market back to you, run. Don't walk, run away.
Okay, enough of the bad stuff. What does a great partner look like in this new world? Well, they listen way more than they talk. They actually use AI in their own work. They're not just talking the talk. They can explain clearly not just why your idea is good, but why you are the right person to build it. And you want to see a history of betting on outsiders, not just the safe bets. You want someone with the humility to say, "I don't know, but I'm excited to learn with you," and who moves fast and respects your time.
I love this quote because it just puts everything back in perspective. VCs aren't fortune tellers. They are managers of capital. They didn't build Instagram. They didn't build WhatsApp. Founders did. You're the one in the driver's seat. You are the expert.
And that's it. That's the simple truth of this new AI era. With the cost collapsing and the timelines shrinking, the power has shifted. It's decisive. Founders have more leverage than they have ever had in history.
So I want to leave you with this one question to carry into your next pitch meeting, or maybe we should call it your next investor interview. The old script is dead. Your job isn't just to convince them you're worthy, it's to figure out if they are worthy of you. So, are you evaluating them as much as they're evaluating you?